Hello traders and welcome to another video. Today we will discuss the three most common chart and candlestick patterns that, of course, works. For those of you who know what are chart and candlestick patterns, feel free to skip this short explanation to the moment when they are described. But for those of you who are beginners and want to know what are those patterns, then the easiest explanation is that traders use candlestick patterns to spot a signal to enter a trade, or predict a possible price movement in order to enter a trade at the right price. It all began when traders could see the price on a computer screen, and they started noticing that in particular zones, the price started to form objects looking very similar to geometrical objects like triangle, square, diamond, etc. So let's begin and check how it looks on the charts. Okay guys, so let's start with the most common candlestick pattern, which is the head and shoulders. And right after that I will say that most probably many of you are familiar with this pattern and were burned by it, and I will tell you most probably why you decided not to trade with it anymore. And the case is that you choose the wrong asset to trade with this pattern. It shouldn't be traded on the currency pairs like Euro USD, for example, or Pound USD, because there are too many false signals. The market makers are drawing the head and shoulders every week, both in both directions, up and down, and it can be very confusing to spot the right one, the right pattern that will work, and you will be just stopped out too many times. And if you will check the statistics, the loss trades will be at least equal, if not greater than the win trades. So what I recommend is to switch to the currency pairs like Canadian dollar against Japanese yen, Australian dollar against the New Zealand dollar, etc. So, but let's start from the beginning, how it looks and how it should be traded. We are marking we should spot and mark the three extremes, in this situation the three highs, and I will mark them right here. We have the first shoulder and the middle one from those three extremes should be the highest one. It should be clearly visible that the middle extreme, the middle high or low, in this situation high, should be higher than the two other highs. So we are marking the head right now and the second shoulder. So this is the visualization of this pattern, and we should also mark the support line on the lows from this whole pattern. So the candlestick pattern should be traded in this way. We marked the support line, and we should enter the trade when this support line is broken in the opposite direction, of course, because this is a reversal pattern. So as you can see, we have broken down here, and this would be our entry point. The take profit is the measurement from the highest point, which is the highest level from this from the head. We measure it, put it down below, and here would be our take profit level. We mark it with the blue line, and stop loss, as you probably can guess it should be a little bit higher than the highest point of the head. I always do in this way, that I add 1 pip above this level and add also the current spread, which was during the opening of the position. And so you can add, I don't know, 1.5. I don't know what is the current spread on LiteForex right now on the Canadian dollar. So it will be more or less 1, 2, or 3 pips above the level, of the highest point of the head. So that is the first, that is the basics how it should be. And let's let's mark all the points that should be considered before trading this chart pattern. First thing is that we need to find 3 consecutive extremes. In this case, the highs. The middle one should be higher than the other 2. So, and yeah, if it is in the opposite direction, the middle one should be lower than the other two lows. So the second thing, we draw a simple trend line along with the highs, and that is our neckline. So third point is that we have right now the classical resistance line, and the sell signal appears when the price breaks this line to the downside. The fourth thing is one of the most important. We need to make sure that there was a clear uptrend ongoing before the first high of the pattern that was formed. And this trend should be at least twice as long as the depth of the middle high of our pattern. If there isn't such trend, the pattern will not be valid and you can't open a position according to it. In our example, there is such a trend and the pattern is valid. Fifth point is that when you trade almost any pattern, you open a position using a pending order, not by the market order. And so we put a pending order right here. So as you probably guessed, the sell stop need to be set at the level of the neckline. So to take profit, as we previously discussed, we need to measure the distance between the highest point in the middle and our neckline. And the stop loss is set a little bit above the high of our entire formation. So this is in a nutshell the head and shoulders. Let's move to another pattern. Okay guys, the second pattern that we will discuss today is the broadening pattern. And I know, of course, you most probably heard of that, but the title of the video is the 3 most common candlestick and chart patterns, so you shouldn't be surprised. But even though if you are, and this is the first time you hear about it, so yeah, that's a good moment to examine how we should trade this pattern. Okay, so this is our British pound to US dollar chart, the 4-hour chart time frame. And to identify this pattern, we need to have 2 consecutive highest high and 2 consecutive lowest lows. And if we have those 4 points, then we can start trading. So let's mark them on the chart. Let's begin with this point. We have the first point, the first high, the second, and here we start from that moment. Okay, so when we have those 4 points, I mean this one, let's also mark them on the chart, please. Yes, third and fourth point. What we are trading this formation is the 5th and the 6th wave. Because each movement of the price is, we can call it a wave in the formation. So we have the first wave, second, third, fourth, and this is the moment when we enter the market. It is hard to predict the crossover point of this resistance, so it is better to trade this formation manually. But this is our entry point basically. Let's mark it with the horizontal line. The stop loss is, as always, a little bit above the highest point of our last high, we can say, as it is in this example. In the opposite direction, it would be below the lowest point. And as I always do, I add 1 point plus current spread to the stop loss. And our take profit, as you probably guess, it will be the opposite side of our boundary, so the support line. So it would be here in this example. This is a very risky pattern because most often it ends after the 6th wave. So, but this is a we can say even too good example, because let's check it, guys. We have the first wave, second, third, fourth. We enter the trade. We have the beautiful 5th wave, and we enter again in the opposite direction here. So we have this. Our take profit can be our entry point. Stop loss again below the lowest point, +1 plus spread, and we have the profit to the infinity and beyond. Even if we extended this resistance line, look guys, Beautiful, beautiful trade. But yeah, 1 in a million, we can say. It it happens not very often. But yes, sometimes the market gives us such a such presents. So this is basically how we trade this formation. What you need to remember is that we need to have 2 points on the upper side, 2 highs and 2 lows. We trade the 5th and the 6th wave. Most often, even if the 6th wave will be a failure, the risk-reward ratio is so great. It is we can say in this example it is more or less 1 to 10, which is very good. So even if the 6th wave will be a failure, even if it doesn't work out, we still have the great profit from the previous trade. So yeah, as for the currency pairs to trade with, in the opposite to the previous head and shoulders, this works very good on the majors like British pound against US dollar and euro against the US dollar as well. So the third and the last candlestick pattern is the volume candlestick, and it basically looks like this, like a very long doji candle with a very small body and very long shadows on each side. So the ratio of the body to the whole candlestick is not more than 10%. The body should be not bigger than 10% of the entire candle's length. The shadows should be at least 40 pips, 400 points on each side. So we can measure it with the ruler. This one has 44 pips and this week has 59 pips. The volume candlestick represents indecision in the market. There are equal numbers of buyers and sellers, and there are also huge amount of orders executed during the formation of this candle. You can also combine it with the volume indicator, where the volume candle will be very huge, represents the bigger amount of orders executed, right? So how do we trade this candle? Very easily. Let's delete this rectangle, and yeah, we set also the pending orders on the opposite side of the maximum levels. So we set the buy stop order on the maximum high of this candle, and we set the sell stop order on the lowest point of this entire candle. So now the take profit. We take the measurement of this corresponding shadow, put it here, and now we see a little bit lower, and now we see the take profit level, which should be in this situation. And again, if it goes to the sell stop order, we measure this entire shadow, mark it here, and yeah, place our take profit order here. The stop loss order should be at the opposite extreme. So for example, for this buy stop order, the stop loss would be right here on the opposite side at the level more or less of the sell stop order. And again, if we are talking about the sell stop order, the stop loss should be on the buy stop order level. You can tell that the risk reward ratio is not great in this formation, but the performance of this formation is 8 out of 10 goes in profit. So you can do the math and deduct that this is a very profitable candlestick pattern, and you have nothing to worry about, that that stop loss is bigger than the take profit in this situation. And also, what is important, if one of the orders is triggered, you need to delete the other one manually. So now let's resume all the conditions that should be made to trade this candlestick pattern. The first one is that you should look for a volume candlestick pattern only in 2 time frames, as I mentioned, the 4-hour time frame and the daily time frame. Each shadow without the candlestick body should be at least 40 pips. The candlestick body shouldn't be longer than the 10% of the entire formation. The color of the candlestick body doesn't matter. An ideal volume candlestick is a doji. Next, you put a buy stop and sell stop at the candlestick high and low respectively. The price target profit is put at the distance shorter than or equal to the length of the corresponding shadow. and a reasonable stop loss is set at the level of the opposite extreme. So when the price hits the level of one of the pending orders, the position will be opened and closed automatically. And as I said lastly, when one of the orders works out, the opposite should be manually cancelled. So guys, that would be it for this video. I will cover more candlestick and chart patterns in the future. So yeah, stay tuned, subscribe, hit a like, and yeah, till next time guys, take care, bye.